Good evening, esteemed colleagues. On the screen, along with me, Sri Muralidharan R, ex-DGM, Risk Management, Bank of Maharashtra, Chennai, and Madam Amita Ajgaonkar, Senior Vice President, RBL Bank, and my colleague in the council, in the committee, Secretary, Shalini Gulati, she herself being an advocate. Let me at the outset welcome all the esteemed colleagues to this very, very important subject and dynamic subject, ever-changing, ever-developing. Best practices in identifying emerging financial crimes risk, the KYC customer due diligence. Friends, you will appreciate that we, the chartered accountants, are directly concerned with this subject. All the governments in the world are grappling continuously and updating how to deal with the risk connected with the underground economies. Globalization is a boon, but along with that comes the cross-border transactions and the accompanying risk. The Financial Action Task Force, FATF, is the global money laundering and terrorist financing watchdog. This intergovernmental body sets international standards that aim to prevent these illegal activities and the harm they cause to the society. With more than 200 countries and jurisdictions committed to implementing them, FATF has developed the FATF recommendations and FATF standards. One of the recommendations, customer due diligence, is the process of assessing risk posed by the current and potential clients. Most AML and CFT measures fall under CDD, as does Know Your Customer. Helps prevent people from opening accounts anonymously or in false names. As chartered accountants, as investigators, we have the expertise in the financial matters, and we have continued exposure to the business and commerce and have a social role to play in the war against money laundering and contribute to the efforts made by the government in this regard. In this context, we have today very, very rich in knowledge and exposure the esteemed two faculties. Because of their vast exposure, because of their continuing connection with the financial transactions and preventive and investigative steps they continuously undertake, I am sure that their deliberations will be very, very enlightening to us. I also expect the participants to actively participate, particularly at the end when question answer session may be shared by the esteemed faculties. With this background, I'll hand over the proceedings to Shalini, formally introduce the learned speakers and take over the proceedings. Shalini, please.
Thank you, sir. We have with us Muralidharan Ramarauji, who is retired Deputy General Manager from Bank of Maharashtra. He is a banker with 34 years of experience in different geographical locations in the country and in various capacities. He has handled assignments including integrated risk management, foreign exchange business, business development, retail and corporate credit, recovery management of retirement funds, audit and compliance. He has held concurrent charge as Chief Compliance Officer of the bank. He has headed the finance function in the bank's head office before his retirement in 2011. He was the member secretary of the Asset Liability Committee and Investment Committee and member of different risk committees in the bank. He was an CAIIB Certified Associate of Indian Institute of Bankers examiner as well. He has received extensive training in banking subjects, particularly in foreign exchange and risk management in India as well as abroad. He is a visiting faculty to the Bank's Training College, National Institute of Bank Management, and Symbiosis Institute of Management Studies and MIT School of Business, Pune. He is a consultant and freelancer corporate trainer in the subjects of banking, finance, and risk management. He has been impaneled as banking expert by the Institute of Banking Personnel Selection, Mumbai, and he works as a member of the interview board for the selection of probationary officers. He has delivered a number of training programs in banking, finance, and risk management in MNCs, banks, open programs, and corporates. He has also attended various training programs in this regard as well. He has attended the Asian Banker Summit held at Jakarta, Indonesia, as the bank's only delegate and participated in the risk governance program. He also attended the FSI World Congress held at Singapore in November 2008. So our next faculty, Ms. Amita Ajgaonkar-ji, I'd like to introduce her as well. She is the Senior Vice President of RBL Bank, Mumbai. She has successfully handled the vital role of KYC and AML compliance of the entire bank in the capacity of being the principal officer of the bank. She ensures compliance to various law enforcement agencies as well as regulators. She has cross-functional experience of 38 years in banking. She has the experience of effectively managing the entire gamut of branch operations. She's currently working as the Vice President and also heading the KYC AML division of the bank. She is the MLRO of the bank for KYC AML compliance and oversees and ensures the reporting of CTR, NTR, CCR, and CBWTR to FIU IND. She's also guiding the other units of the bank with regard to maintaining a balance between KYC compliance vis-a-vis the business growth. She regularly conducts KYC AML training programs across various geographical business locations. Before RBL, she worked for 8 years with the Saraswat Cooperative Bank, wherein she handled the risk management department as an in charge and the principal officer of the bank for KYC AML. Before that, she has also worked for Central Bank of India for 25 years. In 2013-14, she was nominated as the member of working group formed by FIU IND for framing of the guidance note for effective identification and reporting of suspicious transactions by cooperative banks. So with this, I call upon our first speaker, Muralidharan ji, to start his session. Over to you, sir.
Respected Tarun Ghia sir, Chairman of the Chairman of the Committee on Economic, Commercial Laws and Economic Advisory, the Institute of Chartered Accountants of India, Madam Shalini Gulati, the Secretary of the Committee, Madam Amita Ajgaonkar, the Senior Vice President of RBL Bank, and all the participants of this program. Good evening to all of you. At the outset, I am very thankful to you, the Institute of Chartered Accountants of India, for giving me an opportunity to meet all you on this web platform to talk on the subject, the best practices in identifying emerging financial crime risks, KYC, and customer due diligence. A very important topic. Already the chairman has given a very nice introduction about the topic. So let me continue this subject. I will be handling the first portion, that is KYC, and the remaining portion will be handled by the other faculty, Madam Amita Ajgaonkar. Let me start my talk on the subject a little bit philosophically. Mahatma Gandhi has said, there is enough on this planet for everyone's needs, but not for everyone's greed. What a beautiful statement he has made. Mahatma Gandhi has made a lot of statements like this in economics, in banking. In fact, on customer service, he has made some statements. It is displayed in many of the established service establishments like banks and other service establishments. In fact, when I have gone through that, I thought even a management expert also could not have said better. So his words are simple. His English really is very simple. At the same time, very powerful. This quotation, as it says, there is enough on this planet for everyone's needs, but not for everyone's greed. But why I put this slide here, the reasons for financial crimes. The first one, there are so many reasons, but the major reason is human greed. Of course, there are other reasons like organization culture. Research has found out that organization culture also makes a lot of difference in preventing a fraud or even perpetrating a fraud. Some organizations, you can't see any fraud, or it can be the minimal, whereas in some organizations, they are fraud prone. So it all depends upon the culture. So it has been established by research that organization's culture also is important. Then some people have grudge against the country, so they also commit this kind of financial crimes. Some people do it for fun also. It may be really a fun, but it's a fact. Some people say, okay, I will do this crime, catch me if you can. This kind of challenge. For fun also, some people do it. There are some films also on this topic. Anyway, our main point is that the reasons for financial crimes is mainly out of human greed. So before proceeding further, let's see what are these financial crimes. Financial crime is commonly considered as covering the following, like money laundering, terrorist financing, fraud, electronic crime, bribery and corruption, tax evasion, embezzlement, market abuse, and insider dealing, insider trading, information security. All these things are financial crimes. But again, why is the financial sector vulnerable to fraud? But there are reasons. Due to the often complex nature of financial services, detecting and preventing fraud within the financial sector poses an insurmountable challenge. It's very difficult because a lot of different complex nature of services are provided. Secondly, the threats are both domestic and international. They may come from within the organization or outside it, or it can be a collaboration. So these are all the financial crimes, the reasons also. Who commits financial crimes? So if we dig the history, we come to know there are a lot of people from top to bottom, the country head to the lowest employee, all of the people have committed financial crimes. Let's see, just for example, this is only a tip of the iceberg. The Institute of Compliance says there are 7 groups of people who commit the various types of financial crimes. One first type, they are the organized criminals. Organized criminals. They include terrorist groups like Al-Qaeda, Lashkar-e-Taiba. They are increasingly perpetrating large-scale frauds to fund their operations. Then corrupt heads of state, they may use their position and powers to loot the coffers of their own countries. You know, an example is President Suharto, Indonesia. He was the president from 1967 to 1998. So he embezzled the country's money to the extent of $73 billion amount passed through his personal family accounts. And he died at the age of 86 in 2008. Because of his age, no criminal proceedings were taken. He escaped all the punishment because of his age. Then business leaders or senior executives manipulate or misreport financial data in order to misrepresent a company's true financial position. The shining example is Enron 2001. This happened in 2001. Enron company, it is a commodities and energy company, energy producing company in USA. It was stated to be the darling of Wall Street in US. This company got successively for 7 years the best company award. But unfortunately, this company, the CEO of the company himself committed the fraud. And people lost, many investors lost huge wealth in that. Then employees from most senior to the most junior steel company funds and other assets. Recently, 3 employees of a famous company in India, in Mumbai, they executed a fraud of about 20 crores. The company came to know only after the fraud had happened, and they had to fire about 2,000 employees pan-India. Then from outside the company, fraud can be perpetrated by a customer, a supplier, or contractor, or by a person with no connection to the organization. A hacker gained access to 100 million Capital One credit card applications and accounts. This happened in July 2019. Increasingly, the external fraudster is colluding with an employee to achieve bigger and better results more easily. Finally, the seventh group of people, the successful individual criminal, serial or opportunistic fraudsters in possession of their proceeds, or a further group of people who have committed financial crime. In 2017, an employee at Bupa accessed customer information via an in-house customer relationship management system, copied the information, deleted it from the database, and then tried to sell it in the dark web. So we have seen all types of people are committing financial crimes. So that the first thing in risk management is we have to identify the risk, you have to assess the risk, then you have to mitigate the risk, then report the risk, review the risk, and it's a cycle. So for assessing the risk like money laundering, terrorist financing, fraud, bribery and corruption, market abuse, insider trading, tax evasion, embezzlement, forgery, counterfeiting, identity theft, electronic crime, personal purchases, theft, skimming, payroll schemes, billing, so many. Once we have documented the risk which is going to be affecting our organization, we have to prioritize them, and then we have to concentrate on those risks which pose the biggest threat to the organization. So this is what is financial crimes assessment. The money laundering exists in all financial crimes and is a common element that all financial crimes share, irrespective of how they make their money. The money is got, ill-gotten money. Ultimately, it has to be laundered. If it has to be used, it has to be laundered. It means it has to be brought into the banking channels. So that's what is money laundering. So money laundering may be practiced in many different ways and stages. Non-governmental organizations like the FATF, that is Financial Action Task Force, the Egmont Group of FIUs, then Interpol and others, they play a vital role to combat financial crime, including money laundering. Financial crime is not new to the modern world only. It existed even in the 4th century also, maybe even before that also. See, when man and money are there, definitely there will be crime. See, in the Kautilya, otherwise known as Chanakya or Vishnugupta, he has penned the book Arthasastra in 4th century BC. Destruction, he was the mentor of and kingmaker of Chandragupta Maurya's throne in 321 BC. He was considered as the leader. He was a leadership guru. He was an economist, a political science teacher who authored the book Arthasastra. In that book, he summarized 40 types of embezzlement in the 8th chapter, book 2 of Arthasastra, titled Detection of Embezzlement by Government Audits. History repeats, but we only don't learn from history. Same type of frauds which happened those days, which are there in the 40 types of embezzlement, same things are being repeated even today also. That is the pity, really. Okay, now having known this, then what's the remedy for this? So what are all the antidotes for the financial crimes? Know your customer and customer due diligence. These two are the antidotes. They are the effective way to safeguard against the financial crimes, as these processes can generate helpful leads to detect and prevent financial crime. So now I am going to cover the first part of it, KYC. Now, since all these financial crimes, as we already discussed, it is not only domestic, it is international, it is domestic, and all countries, it is there in all countries. So one particular organization cannot prevent it, cannot deal with it. So international and national bodies, they have to drive this anti-money laundering and combating of financing of terrorism. These things can be done. But you know how many organizations are there? FATF is the standard setting body, as Chairman Vyasa told. FATF is the standard setting body at the international level, and they only give all the guidelines for how to prevent money laundering to all the countries. So all the countries have to follow those guidelines. FATF, then World Bank, then the Wolfsberg group of institutions. There are about 13 banks, major banks. So they also are interested in preventing money laundering. Then Egmont group of financial intelligence units. So they exchange information between them, and then they also fight money laundering. Then the Bank for International Settlements, which is situated in a small town called Basel in Switzerland. We all know about Basel Committee, Basel recommendations. So this is the Bank for Settlements. The Basel Committee sits in the Bank for Settlements in Basel. Then Reserve Bank of India being our country's financial regulator, and then Financial Intelligence Unit, Government of India. So this is another body. In addition to that, the FATF style regional bodies are there, like Caribbean Financial Action Task Force, Eurasian Group, then Eastern and Southern Africa Anti-Money Laundering Group, then Intergovernmental Action Group Against Money Laundering, Middle East and North Africa Financial Action Task Force, then this is MENA region. Then the World Bank and the International Monetary Fund, and Basel Committee on Banking Supervision. In addition to that, United Nations, there are a lot of bodies, UN Security Council resolutions, then UN Security Council resolution number, even particular number is also given here. Then UN International Convention for the Suppression of the Financing of Terrorism, UN Convention Against Transnational Organized Crime, UN Convention Against Corruption, UN Global Program Against Money Laundering, and UN Security Council resolutions on Iran. So even today, with all the problems, United Nations is a mighty power. So all these directions come from there. Now, with all these national, international bodies fighting money laundering, then a anti-money laundering framework has been made. This consists of, first of all, know your customer, then reporting of suspicious transactions, then investigation, reporting and compliance to the anti-money laundering guidelines, KYC guidelines, then record keeping and archiving. So this is the AML framework. So now we are going to deal with for some time on the know your customer, KYC. In India, the Prevention of Money Laundering Act, PMLA, was enacted in 2002, but of course, it came into operation only in the year 2005. So the Rule 9 of the Prevention of Money Laundering rules in that act, it says KYC is a process of reasonable efforts. So it says it is a process of reasonable efforts to verify what? True identity and beneficial ownership of accounts. So KYC does not stop with that. It goes further. The nature of customer's business, the source of funds, the reasonableness of operations in the account in relation to the customer's business. So all these data have to be taken. So this helps the banks to manage the risk properly. So if you have all this information, it definitely gives the idea how to manage this risk properly. KYC has got two components, namely identity and address. While identity of a customer remains the same throughout the life, the address of the customer may change, and hence banks are required to periodically update their records. Like for example, as a banker, I moved to the 9 states. I worked in 9 states in the country. In 34 years of experience, service, I was transferred every 4 years, 9 states. So my address kept on changing, whereas my identity remains the same. Verifying the identity of the customer is a legal requirement again. It's a very important aspect of KYC. Verifying the identity of the customer, it is a legal requirement. The two acts are determining that. One is under the Section 35A of the Banking Regulation Act 1949. Under this section, RBI is directing all the banks to identify the customer. Second one is Rule 7 of the Prevention of Money Laundering Act 2002, that is Rules 2005. This also expects the institutions to identify the customer. So it is a requirement of two acts. Now let us briefly see what is the objective of KYC. It is to comply with the PMLA and prevent money laundering, to prevent identity theft, fraud, to prevent terrorist financing, and also to control the risk in the business of lending and transactions between banks and customers. Then it is an important procedure that enables banks, insurance companies, and financial intermediaries to understand their customers better by verifying the customer's true identity and the nature of financial transactions expected in the dealing with that customer. So it means a customer who is dealing with agricultural commodities cannot suddenly get a payment for laptops, export of laptops. He is exporting agricultural commodities. He cannot expect a payment from that. So one should know what is his business and what is his actually dealings or how his dealings are. So KYC is the guiding principle behind anti-money laundering measures. So in other words, we can say if money laundering is the risk, then KYC is the risk mitigation procedure. So it is, if AML is the risk, KYC is the mitigation. Then what are all the documents for KYC? There are two aspects of customer identification procedure. One is establishing the identity of the customer. The other one is establishing the present residential address. So for all of us are very aware, even in the telephone service providers, mobile service providers, they all know, as whenever we go there for anything, they ask for the banks also. They require a document carrying photo of the customer, such as driving license, passport, PAN card, voter's card. And these documents may or may not carry the present residential address. To establish the present residential address of the customer, the bank may ask for utility bills such as telephone bill or electricity bill, gas bill, whatever it is. So the objective of KYC guidelines already we saw is to prevent and to the banks and financial institutions being used intentionally or unintentionally by criminal elements for money laundering. So guidelines on KYC have been issued by all regulators like Reserve Bank of India for banking regulator, SEBI, that is for the companies, regulator of the companies, then NHB, of course, NSB has become a part of Reserve Bank now, then NABARD is being a regulator of cooperative bank, agricultural institutions, and IRDAI for the institutions coming under the insurance companies. So KYC guidelines stipulate that the banks and financial institutions follow some of the important guidelines like customer acceptance, customer identification, transaction monitoring, and risk management process. Customer acceptance is to ensure that only legitimate and bona fide customers are accepted. Only the legitimate and bona fide customers are accepted. So in Ashok Vihar, Delhi branch, there was a fraud of 6,000 crores a few years back, which was a very big fraud, despite all the rules and regulations in force, that was all illegitimate accounts were opened. Fictitious accounts were opened in the name of the security personnel, slum dwellers and all were fictitious accounts. So here only this assumes importance. Then customer identification, to know the risk they may pose to the bank. Then to prevent, detect illegal activities. Then risk management processes to effectively manage the risk posed by the customers trying to misuse the facilities. The RBI has given a latest view in January 2020. They have also permitted the video customer identification. That is, through video, we can do the customer identification, and also we can also do the geo tagging, where the customer is, live location of the customer, so can be captured. So these guidelines are very clearly given by RBI in their circular dated January 9th, 2020. So only thing is regulated entities will have to ensure that the video recording is stored in a safe and secure manner and bears the date and time stamp. Now, Central KYC Registry is another important landmark in KYC. A centralized repository of KYC records of customers in the financial sector with uniform KYC norms and facilitates interusability of KYC records across the financial sector. So the objective is to reduce the burden of producing KYC documents every time. So it keeps the KYC registry keeps records of all customers in financial sector, which can be used by all banks and their FIs and intermediaries. They can have to pay a small fees and they can take the data. It helps institutions to find out if the client is KYC compliant based on Aadhaar, PAN, or other identity proofs. Once the KYC details are updated on this platform by one entity, all other institutions can update on real-time basis. So this is the beauty of Central KYC Registry. So KYC Registry helps firms cut down the costs also substantially by avoiding multiplicity of registration and data upkeep. So the KYC data uploaded on this platform will be deduplicated on the basis of demographic, namely customer name, maiden name, gender, date of birth, mother's name, father's name, spouse name, address, mobile number, email ID, all these things. Another important aspect of KYC is KYC updation. KYC updation is very important to update the customer identification documents periodically. It does not mean once we take KYC at the time of opening of the account, it is not the end of it. So the KYC has to be updated periodically. That periodicity is decided by under what type of customer, what type of the risk category the customer has been assigned. So every customer, when he in a bank enters into onboards any customer, then it has to immediately give a risk rating like low risk, medium risk, or high risk. This is an international standard. So all banks in the world, they have to do this. So this is what is called customer profiling. So once you do the customer profiling, depending upon this risk profile, the KYC updation periodicity changes. So RBI guidelines requires banks in India to introduce a system of periodical updation of customer identification data. For low risk customers, every 10 years only you have to do the updation. See how much of leverage, how much of benefit, freedom bank RBI has given. For medium risk category, every 8 years it has to be done updation, and high risk category every 2 years. Then, since KYC updation is to be carried out based on the risk category of the customer, it becomes essential that all customers of the bank have been given a risk category before proceeding for KYC updation. Then, how to do this updation? The next question comes: how to do this KYC updation? It can be customer contact directly. It can be through relationship KYC, or there are some other surrogate methods, or accounts transfer branch to branch. In the customer contact method, bank can contact the customers directly through various means such as branch when he walks into the branch, or we can send an email, or we can telephone to him, and then we can send somebody to his house, or he can come to the bank. But this requires resources, and it costs. It's a high cost method. Then relationship KYC, existing accounts holders require additional accounts. So if existing is outdated, can ask for fresh set that will serve the purpose for new and old account. Then surrogate methods, verified with independent and authentic public sources and confirmed, like PAN from income tax website, company details from Ministry of Corporate Affairs, scanned copies through secured channel emails instead of physical documents. Then account transfer branch to branch. KYC once done by one branch or the bank, the customer should be allowed to transfer his account from one branch to another branch without restrictions. See, nowadays, under CBS system, a customer is the customer of the bank and not customer of a branch. So if his KYC is done at one branch, it means it is enough. And here, important thing which you should remember is identity of a customer does not change over a lifetime of the customer. The identity verification needs to be done only to confirm his current existence and validity of the document, identity document. Then you can see one specimen how KYC updation has been done by one of the public sector bank, Canara Bank. So they are given a public notice to all the customers of the bank like this in the newspaper, and then they try to get all these things from the customers. Then another important aspect of KYC is beneficial ownership. This is the most important aspect. Every banking company and financial institution, as the case may be, shall identify the beneficial owner and take all reasonable steps to verify his identity. What is this beneficial owner? The term beneficial owner has been defined as the natural person. He is a single person. He is a person who ultimately owns or controls a client, and the person on whose behalf the transaction is being conducted, and includes a person who exercises ultimate effective control over a juridical person. Juridical person means a company. So this is what is the definition of beneficial owner. So again, some more clarifications one needs. Beneficial owner is always an individual. It's a natural person. It means it's a human being. Therefore, the beneficial owner can only be an individual and not a company or organization. The first and foremost understanding. Each time you apply the test of beneficial ownership to a customer, you must apply these three elements. These three elements are who owns more than certain percent of the customer. So if the customer is a company, who owns more than certain percent of that company? What is his ownership percentage? Then who has effective control of the company, that customer? Then the persons on whose behalf a transaction is conducted. So these three tests are very important. Some, for example, even though this is little old, I am trying to give you this. See, in case of a trust, the identity of the settler of the trust, the trustee, the protector, the beneficiary with 15% or more interest in the trust, and any other natural person exercising ultimate effective control over the trust through a chain of control or ownership. So he is the beneficial owner. Then in case of a partnership or company, natural person with controlling ownership, more than 25% of shares or capital or profits he should be having, then more than 15% of the capital or profits for a proprietorship or partnership company or association of persons. So identity of the natural person exercising control over the juridical person through other means like voting rights, agreement, arrangements, etc. So if no natural person is identifiable from the above two, the identity of the relevant natural person who holds the position of senior managing official, he is the beneficial owner. So the listed company or is a majority owned subsidiary of such a company, it is not necessary to verify any shareholder or beneficial ownership. So this is some clarifications about beneficial ownership. What is the definition and also what it means and who can be the beneficial owner for different entities. Then it is crucial to know who the beneficial owners are so that you can make appropriate decisions about the level of money laundering and terrorist financing risk associated with your customer. Suppose if the people behind a company are dubious people, then it means they may commit many financial crimes, including money laundering. So that is why the beneficial owners is very important. If bad people are behind the scene as a beneficial owner, then that is very dangerous. That is the reason why we should see the beneficial owner. Who is the beneficial owner? Then effective control of a customer is part of the beneficial ownership definition. An example is an individual who exercises responsibility for senior management decisions. Acting on behalf of a customer is not the beneficial ownership definition. Suppose if a chartered accountant or an advocate is acting on behalf of some customer, so it means he is not a beneficial owner. So that has to be remembered. One or two examples are given here. The Rule 9 of the Prevention of PMLA Act, PMLA rules tells a company, for example, X company is there here in the example. Mr. Smith owes 75% of the holding, and Y company is holding 25%, and Mrs. Jones and Mr. Winston each they both have this 25% holding. But here Mr. Smith having more control, that is 75% of the shareholding. That is why he is the beneficial owner. So this is how it has to be found out. And then, of course, now there were lot of problems. The committee on the legalship company law committee noted that complex structures and chains of corporate vehicles are used to hide the real owners behind the transactions made using those structures. See, that is why it required some amendment. So hence, identifying the company's beneficial owners is absolutely essential to the fight against money laundering. So this was realized by FATF. So based on the FATF recommendations, on 8 February 2019, the Ministry of Corporate Affairs released the company's, that is significant beneficial owners amendment rules 2019, amending the Companies Act, Companies Rules 2018, introducing in India a significant beneficial owner disclosure regime. So in short, what it means an individual who owns or exercises control in the company by way of either holding shares or voting rights or having significant influence in the excess of 10% of the total shares or rights, or held or exercised either directly by him or indirectly through his relatives or entities in which he has significant influence of, or both. So in fact, this requires a lot of explanation with examples. Due to paucity of time, I am not doing that, but there is a lot of material on the in the net. You can see that is this amendment. It gives a lot of clarifications. Initially, there were a lot of confusion. Those confusions have been clarified. Now, having known the lot about various financial crimes and also penalty, the KYC, customer due diligence, and beneficial ownership identification, KYC updation, with all these things are done. But still, there has been a lot of violations on KYC and AML. Now, here I have given a few examples, but this is only a tip of the iceberg. Every other day, some reports are coming that either in foreign countries or in our country, some bank or financial institution has been fined for KYC AML violation. For example, HSBC to pay $1.9 billion US dollars as a fine in a money laundering case. So it means it was in the year 2012. This $1.9 billion, it amounts to 8.5% of that year's profit of that HSBC bank. You know, HSBC Bank is one of the top 29 banks, systemically important banks in the world. There is no Indian bank figures in that, including State Bank of India. But whereas HSBC is one of the top 10 banks in the world, which is figuring as the globally systemic important banks. So in that bank, this kind of things are happening means one cannot imagine. Then Deutsche Bank was fined 163 million pounds for KYC AML violation in 2017. RBI penalized 22 banks KYC AML violation in India. Almost all banks, I can say. What the regulators found in these banks? Non-adherence to guidelines like customer identification procedure, risk categorization, periodical review of risk profiling of accounts, periodical KYC updation. So all these were the lapses. For this, many banks were fined 5 crores, 2 crores, 3 crores, depending upon the veracity of violation. Then RBI penalizes Axis Bank 25 lakhs for KYC recent September 2021. Rupees 6,000 crore money laundering case, Bank of Baroda in Ashok Vihar, New Delhi, 2015. Then AML KYC violation in 2020, Goldman Sachs fined 9.39 billion euro. Commerce Bank, Germany, fined 37.8 million pounds. Westpac, Australia, $1.3 billion. Then SEB Bank fined 107 million. What is the reason? 82 cases of transaction monitoring, 109 cases of poor AML compliance, 115 cases of lack of customer due diligence. See, in spite of all these things, this is only a tip of the iceberg. I am telling there were so many violations. And when Dr. Raghuram Rajan was RBI governor, he once said that the paying penalties by the banks for AML KYC violation, they have taken it as cost of doing business. See how bad it is. If they take this paying fine as cost of doing business, then that is the end of it. So it cannot be like that. So now, that should be what the regulators expect is the minimum expectations. But what are all the best practices to counter financial crimes? Yes, whatever existing KYC, CDD is definitely they are able to detect the information and prevent. But we have to follow that in the first place. Second thing, we should go beyond compliance. So what are the best practices to counter financial crimes? The strict compliance to existing KYC AML guidelines. The KYC AML program should be beyond compliance. It's not now people are not even complying, but we should go much beyond compliance. Then advanced risk rating models to be developed or being developed, of course, which improve the detection by applying machine learning and statistical analysis to better quality data and dynamic customer profiles, making your KYC remediation efforts risk-based and value-based. The network analytics should be used for detecting financial crime, fraud, and cyber operations. Then increasing the understanding of trade-based money laundering. Nowadays, the money laundering, people are using the international trade more for money laundering because there is a lot of laxity in trade-based money laundering. In international trade, there is not much of, there is a lot of scope for the money launderers to do that because of the poor monitoring and poor checking. So financial intelligence collected by the financial intelligence units have to be exchanged. Of course, they are doing now. Then FIU, that is financial intelligence units, analytical approaches to trade-based money laundering, that has to be improved. And role of customs in countering trade-based money laundering also should be enhanced in the sense. Now, the customs, they do only test check. Only 5% of the imports they check. Exports, they don't check at all. So price manipulation is there, under invoicing of imports, over invoicing of exports, then then quantity shipped, then no goods are not shipped at all, but invoice are paid. Many invoices are being used for payment of the same thing. So like this, there are so many techniques the money launderers are using for money laundering in the trade-based money laundering. So now, these are all some of the important the prescriptions given by even FATF. Public-private partnerships, that has to be, they got tremendous value in identifying the trends as information is able to be shared in a controlled setting that may not be detected just within one institution. So this is public-private partnership is very important. Then data analytics. So now that we have the advantage of data analytics, banks and government entities have invested heavily in technology to improve their ability to identify anomalies in payments, non-documentary and documentary trade. Certain types of data analytics have been highly successful when used by the government to identify and combat the trade-based financial crime. Then artificial intelligence and cognitive computing have emerged as a promising technologies that learn and adapt as more information is provided. This is valuable to all stakeholders to be able to identify complex patterns, both in post-transaction audits and in predictive models, which is very powerful. Then another thing is distributed ledger technology. This is what is used even in Bitcoins. So it is very difficult to crack. So this is banks and fintech community. They are at work trying to apply the benefits of technology to solve the business problems. A proof of concept run by banks in Singapore demonstrated that distributed ledger technology was able to mitigate the multiple invoicing fraud problem. So I will finish this within another 5 minutes. There is one small case study which is taking only a few minutes. Transactions such as payments for consultancy fees, commission charges, agent fees, freight charges, or even proprietary payment, or even just building up savings, etc., may seem low risk at first glance. See, sending money for these purposes, like consultancy fees, commission charges, agent fees, sending money for this, they may look to be very simple. But after conducting the KYC or CDD or enhanced due diligence, of those transactions, it is mostly found third-party connectivity and opaque beneficial ownership structures. In fact, one compliance officer has given this report. In one case, it involved $1 lakh transaction from the home base country to China, where the following documents were attached. The request form was there, company valid trade license, invoice, world check report, sanction screening report, such details about the company, details of the beneficial company, source of the funds, bank check. So all these things were given. But when proper KYC CDD was conducted, he says, I came to know this conclusion that fake signatures on the request form. Request form was having fake signature. The trade license was valid, but the company does not have a physical office. It was a shell company. Then opaque ownership structure. Invoice was fake. Improper fonts and basic requirements are missing. Payment terms are advance payment, because in this case, you will not be able to inquire bill of lading at the initial stage because advance payment, okay. Then payment terms are dubious. Item prices are not matched with the current running prices. Beneficiary company is only a shell company. It means company is not physical existence is there. EDD, enhanced due diligence report showed no movement of goods, only movement of funds. Investigating the ordering customer and the ultimate ordering customer revealed it was ordered from a high-risk jurisdiction without EDD. High risk, there are some countries like North Korea, they are all high-risk jurisdictions, Cayman Islands. So if any request comes from there, any order, it means you have to be suspicious. But it has been from that high-risk jurisdiction only. Then sanction screening was okay. That was done properly. Meta-search did not give proper record of the beneficial company, did not give any detail. Then ordering customer gave a check of a bank to make the company, to make the payment of this transaction that it is through bank. But the company was not able to justify the source of funds. In fact, the money came to him by a predicate offense. Predicate offense means it's a component of a major offense, like embezzlement or tax evasion. They are all predicate offenses. So this money also came from predicate offense only. So this is only after conducting some KYC CDD, all this came to know. Otherwise, on the first look of it, this appeared to be okay. And then another one, the many money launderers control exchange houses directly or indirectly and disguise themselves behind the wall of corporate culture. They finance the exchange companies to meet the capital adequacy requirements and continue their operations. In such exchange house, they also employ qualified people and even pay more to the compliance officers to construct a strong wall to ostensibly give the appearance of legitimacy and to better hide their wrongdoings, including by giving false reports to regulators. So regulatory criteria for identification of beneficial owners in exchange houses should be very stringent, and even compliance officers' background check has to be made. Then it can be prevented. So regulators should also coordinate with the background checks. So my last slide on the topic. In fact, I will suggest all the participants to see these two films on the OTT platforms. They are available. In fact, I have seen this TV. In fact, I have recommended this viewing of these films and also the web series for many of the lectures I have addressed for AML KYC programs. Dirty Money Cartel Bank. This is the title of the movie. This is the story of HSBC's anti-money laundering lapses and the hundreds of millions of dollars the bank ultimately admitted laundering for drug cartels, as well as the response from regulators, law enforcement authorities, and even Congress. Scam 1992, then web series on Harshad Mehta stock market scam. And there is a film on even Telgi also, the stamp scam. So, friends, I hope I could do some justice for the topic which I have given. If there are any questions, that may be, please.
Thank you, sir. So we have some questions from the participants. I'd like to take a few since we have only 5 minutes.
Right.
So, sir, the first question is, though the past performance of the customer shows a good track record, he may show negative sign in the future. So how to avoid this situation?
If the customer does it unknowingly, he can be educated. but we don't know. If there is every possibility a good customer can become bad customer also. See, human psychology is very fragile. He can, if he becomes a bad customer, all the customer due diligence, all these things have to be done. There is no alternative. If he does unknowingly, then of course education will help. Otherwise, our procedures. That is why even when Enroll failed, people, all the economists in the world, you know what they said? Even if your client is a superstar customer, corporate, subject him to all rigors of credit monitoring. That's what all the economists said. So similarly, here in this case, if he does it intentionally, then we have to subject him to all rigors of KYC CDD.
Okay, sir. So I'll move to the next question. It says a random client comes to us looking at our online presence. We have collected their validated Aadhaar, PAN, passport, and related documents and incorporated a private limited company. Later, we find that the documents are forged. So what to do in this situation?
Definitely, we have to take up with him. In fact, we have to call him. We have to close his account, and then we have to report him to police. Yes, we have to catch and punish these clients, so that he will not be able to do that in any other bank. He will be blacklisted.
Okay, sir. So then the next question is, using sophisticated digital tools, how can we trace fraud with reference to impersonation?
Can you repeat the question?
So using sophisticated digital tools, how we can trace fraud with reference to impersonation?
See, actually, there are various techniques available in the software technology. They are able to detect by patterns, by even by linking some of his earlier transactions, current transactions. Some softwares claim that a needle in a haystack can be found. A needle, they are able to find frauds or patterns in such a way that a needle in a haystack can be found. So to that extent, today we have the digital technology. So finding identity is not at all an issue.
Okay, sir. So the next question is, when so many transactions take place in a day in the bank, so how to identify suspicious transactions?
See, suspicious transactions, for all these things, the bank has got softwares. It is humanly not possible to see each and every transaction and do the suspicious, call out the suspicious transactions. There is a lot of, the software throws a lot of, alerts based upon the parameterization which has been given in the software. So that will take care. And not only that, based upon experience, the regulators, they have given a lot of guidance on this topic. What should arouse suspicion in case of a transaction? For example, a customer who is known to dealing with resin only, whereas he is getting a big remittance of 50 lakhs of rupees. When we ask the reason, he says export of watches. These are all real case studies, I'm telling you. What example I gave, real case study. Then when he is not able to give the answer, then again we have to do a lot of due diligence. Then we found out it's a fraud, it's a money laundering.
Okay. Sir, I'll move to the last question. How does the bank classify customers into low risk, medium risk, and high risk? What is the basis followed by the bank?
Right. Again, for here also, there is a guidance by the regulator. For example, a salaried person, even by your own logic also, what risk he can pose to you? After all, he is getting monthly salary. That's all. Maybe a lakh of rupees maximum, 1 lakh, 2 lakhs. What he can do? So he is posing a low risk. Then suppose if he is a non-resident Indian, or if he is an exporter, or if he is a politically exposed person, they may transact very big transactions involving lakhs and even crores of rupees. So they should be classified either as medium risk or high risk. So this kind of guidance is also there from the regulators. And again, based upon our experience also, we can categorize the customer. For example, a good customer who is having a small proprietary business, a small business in a bank, he can become a criminal also. We don't know. He may be involved in money laundering. So that time when there are some adverse report about him in the market or in the media, immediately we have to classify him as from low risk to high risk.
So thank you so much, sir. With this, I like to thank you for sharing your extensive knowledge on the subject. I hope the participants are going to gain a lot of knowledge from what you have spoken today. So thank you so much, sir, on behalf of the Committee on Economic Commercial Laws, as well as on behalf of the Institute. Thank you, sir.
Thank you very much. Thank you.
So I'd like to call upon Amita ma'am to start on with her session, please.
Good evening, everybody. I'll just share my screen.
Yes. Now you can share your screen, ma'am.
Yeah. Good evening, everybody. After a very, I have no words the way Muralidharan sir has really taken us through the KYC and the financial crimes. It was full-fledged knowledge basket for us. So let me just add on some things where Muralidharan sir has already started, and let me take this forward. Just to begin with, first of all, let me tell all of you that whatever I am speaking here are the best practices in the banking industry. There is nothing which has to be related to my current organization or my previous organizations. These are the general statements. Do not take it as that this is happening in this organization or that organization. It is a general market practices which I would like to share with all of you. So let us start with it, the customer due diligence. So sir has already covered the financial crimes, but just to get the flow of it, I have just put one or two slides on financial crime, money laundering, terrorist financing, bribery, corruption, tax evasion, insider dealing. Here I would like to add that tax evasion is not a predicate offense as per PMLA. However, all the offenses finally end up, all the money laundering almost ends up at tax evasion only. The motive of most of the money laundering cases are tax evasion. So it is one of the financial crime. I would not get much into the legal about it, but in general, yes, it is treated as a crime in general terms. Then the next I will come to the emerging financial crimes. These are some crimes, like OTP frauds. Most of you are aware of it, like, your colleagues, your family members, your drivers, your maid servants, day in, day out, you hear from somebody or the other saying that there was a call which came and they asked me for the OTP and my money has gone. It has become so frequent, day in, day out, and we in the banks, we receive daily, there are 2 to 3 notices from the cybercrime departments, from the police departments, where, 1 minute, I think my video got, sorry. So day in, day out, we are hearing such news of OTP frauds. Then there is identity theft. I could just share one of the experience that in one of the matrimonial site, a person posed as a to be groom, and then he connected with he used to connect with the girls and prospective brides, and then tell them that I'm sending a gift, and that there will be a call saying you have to pay the custom duty, and because it's a gift and they don't want to hurt the boy, and then they pay the custom duty, and then they are told you have to also pay some insurance because there is a jewelry in it, and then it strikes that the victim that she has been defrauded. And when checked with the matrimony site, they come to know that it was identity theft. This is one of the cases I am telling. There are many other cases of identity theft. The one at a time will not be enough to share many other cases, but just touching, job frauds. Again, we find a lot of such cases where people are lured saying that you'll get a job in immediately a job, and you have to pay. Even some job links or some wrong links, you go there and you find that they take charge of your phone or your laptop, and they hack your passwords, and then you are defrauded. That is again quite a very well-known fraud, but that time it was in small cash amount and this, but now this is really very, very important. It's not just that penalty ho jayega isliye karna hai. No, we have to safeguard our institution, we have to safeguard our country, we have to safeguard our customers. So like there are a lot of guidelines with regards to IT security, with regards to password securities. These things have to be taken care of if we really want to be safe. Then next comes transparent client relationship, KYC and CDD. Sir has already covered KYC. I'll be covering CDD in the subsequent slides. So transparent client, we should know everything about our client. I'll speak on this point further. Ongoing training to the employees. This is very important. Employees should be, it's not that the employees should be trained only for business enhancement. They have to be trained for how to arrest, how to identify the financial crime, what timely action should be taken. And yes, it is not the duty only of the AML team and the FRM team and vigilance team. Every employee of the bank, of the financial institution, should be aware of how to foresee something wrong happening, and take immediate actions. Whatever, reporting to the MLRO, reporting to the police, whatever, reporting to the vigilance team, reporting to compliance, all those things. There are policies in place in every financial institution that if such a crime is observed, or if it is noticed, if the customer approaches you, what is the process to be followed for immediate action by the employees. So training is important. Then comes awareness program for customers. Again, that is, the customers should be made aware that they're not supposed to share the OTP. They're not supposed to share the password even with their family members. They should not share, hand over their checkbook to anybody, sign checks, or while signing any forms, they should be careful. So these things, these awareness programs are a must for the customers as well, because safety of our customers is safety of the institution. Then comes continuous monitoring of the client data, transactions and accounts. Again, this I'll be covering in the future subsequent slides. Risk-based approach in handling the accounts. Sir has already covered risk-based approach. That is, every customer in the bank has to be risk categorized to either low risk, medium risk, high risk. I would like to elaborate here a bit that every customer at the time of onboarding is categorized basis his profile, whether if she's a housewife, she'll be a low risk. If he's a salaried person, it will be a low risk. If he's working in gems and jewelry, it will be in high risk. And then which country he belongs to. If it is an NRE account, and if the prospective customer is residing in a high risk country, then he would be high risk. If there is a foreign student who has come from a high-risk country, it would be high risk. that way. Otherwise, local students will be low risk, minor is a low risk, and government entities, government organizations will be low risk. PEPs would be high risk, politically exposed person will be high risk. RBI has given an indicative list of, in the master direction, RBI has given an indicative list of high risk customer, medium risk and low risk. It is an indicative list. Banks can take their own call depending upon their risk appetite. So this is how the onboarding risk is calculated. Going forward, as per the regulator, every half year, risk categorization of the customer has to be reviewed and updated. Now, once at the time of onboarding, it is only the profile of the customer. But once he is onboarded and once he starts transacting, every 6 months, we do the review. This time it is basis the transaction pattern in his account. If there is huge turnover in the account, not matching with his profile or so, then it would be high risk. If it is very less turnover, if it is as per then it would be low risk. It will also depend on the product of the bank, if the product is low risk, high risk, medium risk. Again, here also, if it is PEP, it will be high risk even if there are no transactions, depending on if that bank has treated the PEP as a high risk in their policy. You see, so that way, gems and jewelry, real estate, casinos, ideally most of the banks treat them as high risk. So there, even if there are few transactions, but it is an overriding factor, and then that is, suppose a customer is doing too much of cash transactions, then it is even if it is a cash intensive business, we are treating them as high risk. Banks are treating them as high risk, depending on the policy, depending on the thresholds and parameters. So this is all about the review of risk categorization, because I thought that there was a question in the earlier session that how the risk category is done. I thought I would elaborate it that way. So this is how risk categorization is done and updated every half year for every customer. Then every financial institution has to have a money laundering, anti-money laundering team and a money laundering MLRO, money laundering officer. Then there is an FRM team. These are there, the AML team, the FRM team and vigilance team are all there just as a part of controlling the financial crime, to identifying it, taking steps to avoid this. There are policies which, basis on the previous frauds, there are policies to curtail or to reduce these risk. Risk can never be nullified, but yes, it can be mitigated, it can be minimized. Then comes the dynamic AML software. There was a question in last session that how suspicious transactions are identified. Yes, as sir has already told, that there are AML softwares with every financial institution. There are the rules set in these softwares under guidance of FIUIND, IBA, RBI. There are, and yes, even the SEBI, all regulators, there are rules given. With these rules, the softwares generate the alerts. These alerts are then used for scrutinizing the accounts, and basis the alert, if it is observed that the transactions are not as per the profile, then the same are reported as suspicious transaction to FIUIND. And FIUIND then further takes it forward to the various law enforcement agency, concerned law enforcement agencies, depending on the type of suspicious nature. Then we come to the last point. Yes, AML softwares have to be very dynamic, because as you all know, fraudsters are always one step ahead of the regulators and all those who are trying to mitigate the risk. They're always one step ahead. As a result, I remember in age-old days, the regulators used to have one circular in a year for KYC AML, but now it is updated now and then, because they have to keep pace with the increase in crime. And if there are new guidelines day in, day out, the software should also be very dynamic. They should be capable of adding rules, adding the scenarios. And one more step forward for dynamic AML software is the artificial intelligence and machine learning. This is the future of our economy, of our banking industry. Already the regulators, LEAs, have started using artificial intelligence and machine learning. Many of the financial institutions have started it, and it has to be, the importance has to be given to artificial intelligence and machine learning. Sooner we do it, we are going to mitigate this risk faster. I hope I'm not very fast in this program.
No, ma'am, it's fine. You can
Shalini, I think it's not very fast, right?
No,
so
ma'am.
Let us now go to customer due diligence. Customer due diligence, as earlier mentioned, it is a key component of financial crime control framework. CDD refers to the due diligence that FIs must perform to identify their clients. CDD aims to improve the financial transparency and prevent criminals and terrorists from misusing the companies to disguise their illicit activities and launder their ill-gotten gains. CDD is the process of evaluating your customers' backgrounds to get an accurate picture of their profiles. This is sort of, though I have read it out, I think it is quite self-explanatory that customer due diligence is just to know your customer. Know your customer. Let me tell you all, in age-old days, 30 years, as Shalini has already introduced me, 39 years of bank service in banking industry. As a new joinee, we used to open accounts just basis one request letter and one photograph. And we had such few customers in the bank that we knew them by name, we knew their families. Not only that, many of them, we knew them by their account numbers. We used to say, "Arey, 3481 aaya hai." We used to know them with their account numbers. We knew the health of their account. We knew their health also. That close we were with our customers. And it was very safe those days. There were very few people coming to the banks, and financial crime were almost nil at that time, almost nil. But then gradually, as the customer base started increasing, knowing all customers was becoming difficult. And then the regulators introduced introduction. That is, every bank account was to be opened only with the introduction given by the existing customer. And then there was a ration card, which was introduced as a KYC document. Then going forward, gradually there was increase in the KYC documents, because ration card was not always, it was found that ration cards were not updated or so, it was 20 years old ration card and the address on that may not be the current address. And gradually the regulators started working more on the KYC. Then came PMLA in 2005, though it was 2002, but yes, it was it was implemented from 2005. And then with PMLA, we came out with more KYC documents like, electricity bill and driving license, all those things. And then gradually introduction requirement was withdrawn and more thrust was given on documents. That time we used to say, I have all the documents of the customer proper in place. Now, even if he has done any fraud, I am safe. The bank is safe. There won't be any penalty for the bank, because for every audit, in RBI audit, every investigations, they used to only check, are the documents in place? Yes, all the documents are in place. There was an address proof, there was an identity proof, original was verified as per the stamp put on the document. So yes, no, nothing to worry. We know we have done our job and the bank is safe. There won't be any penalty for the bank. But that was only for some days, and gradually then after that it was, KYD, know your documents, that way it was. But then going forward, it was know your customer. Know your customer. It is not just that you have the document and you are safe. No. Bank's duty is to go much beyond the document. The person who is onboarding the customer has to go much beyond the document. He has to make further inquiries. He has to validate those documents. So we had to then move from just KYC to CDD. KYC is a part of CDD. So taking document is a part of CDD, but CDD is a broader term. There you need to know your customer more in depth. How to do CDD, I'll be covering in the subsequent slides. But yes, that is CDD. This is how CDD has evolved. In between, I missed out that from ration card to electricity bills. Then in 2008, PMLA came out with OVD, officially valid document. Officially valid documents means it was strictly Aadhaar card, passport, Aadhaar card, passport, driving license, election card, Narega card. These were some OVD, officially valid document. These are the officially valid document which are 100% required for onboarding a customer. PAN is not an OVD. There is a misconception. PAN is not an OVD. PAN is taken as a part of tax requirement under income tax rule, though it is mandatory. Obtaining a PAN or Form 60 is mandatory, but it is not an officially valid document as per PMLA. It is as per the income tax rule that we have to take the PAN card. Okay, so identity and address proof, we have to take Aadhaar card, driving license, all those things. Utility bills are not an OVD. Again, there is a misconception, but utility bills are not officially valid document for address at all. So this is with regard to KYC. CDD, we will talk further. Let us see the next question, because I presume that these will be the questions in your mind. Shalini told me there won't be any direct questions in between, so I thought let me frame the questions on behalf of you, of all the viewers. So is CDD required for all accounts? Again, CDD, again, during my age-old banking, we used to always concentrate only on monitoring the loan accounts, the asset account, because we were worried about NPAs. We were worried about the losses to the bank because of NPA, But as PMLA came and as the importance of PMLA came, as we became the FATF member, what was important is monitoring the liability account. That is the current account, saving account, FDs, RDs. It was very, very important. Along with the loan accounts, we are expected to monitor even the liability accounts, the current saving accounts. So what is the answer? CDD is required for all accounts, for all customers, even if that person is opening a small, just a saving account. If he is a salaried, Still, he may be low risk, but CDD is required for all customers. So just, monitoring loan accounts, if something goes wrong in loan account, it is credit risk. It is loss to the bank. But if something goes wrong in the liability accounts, and of course, any money laundering happening in loan accounts as well. If something goes wrong in the current account, saving account, with money laundering perspective, bank will face a penalty. Banks will have a reputation risk. Even we have seen banks collapsing in the banking industry just because of the money laundering activities. So CDD is required for all the accounts, all the customers. Is CDD also required for authorized signatory and beneficial owner? Yes, of course. We have to do CDD of every individual, be it the account holder, be it an authorized signatory, be it a power of attorney holder, be it a guardian, be it a beneficial owner. We have to do the CDD for each and every customer. Is CDD a one-time activity? No. CDD is not a one-time activity. CDD is an ongoing activity. KYC, taking KYC, we take it at the time of onboarding, we take it at the time of free KYC, that is all. But CDD, as I told you, it is a broader concept, right from taking the KYC, validating the KYC, to transaction monitoring, continuous profiling of the customer, risk categorization, all that is a part of CDD. So CDD is not a one-time activity. Just a quick glance to the CDD defined by FATF. Let me tell you, you all are aware, I'm sure you all are aware that Financial Action Task Force FATF review is due. It was due, in fact, 1 year back, but because of the pandemic, it has got postponed again 2-3 times. And we are expecting it somewhere in September, October, some dates are coming. So we are all preparing for that FATF review. And as a result, it was necessary that everybody knows what is the definition of CDD as defined by FATF. It is identifying the customer and verifying that customer's identity using reliable, independent source documents, data, or information. That is, validating the documents, identifying the beneficial owner. I think Muralidharan sir has covered beneficial owner in quite detail, so I need not spend much time on beneficial owner. Then comes obtaining the information on purpose and intended nature of the business relationship. As I told you, only KYC taking is not enough. We should know what is his nature of business, or what is the activity, what is the source of income. Conducting ongoing due diligence of the business relationship and scrutiny of transaction undertaken throughout the course of that relationship, to ensure that the transactions being conducted are consistent with the institution's knowledge of the customer, their business and risk profile, including where necessary, the source of fund, the end use of funds. You should know everything about the customer. We will go further in detail on this, but this is to do with the definition as defined, definition of CDD as per FATF. Types of customer due diligence. Standard customer due diligence. This is a basic examination of a predetermined set of factors to assess the risk level of potential customers. That means basic at the time of onboarding, you should know whether the customer is salaried, a businessman, a proprietor, a partner, a director, or a senior citizen, a retired pensioner. You should know what that customer is. This basic, you have to know. You cannot onboard a customer without knowing that basic requirement, whether the person is a student, a housewife, a tuition teacher, whatever she is doing, we should know that. That is a basic requirement, you know. And like, you know, where she's staying, the address, the identity, these are the basic identity, address, and basic what the person is doing is a standard customer due diligence. Okay, which whatever be the risk of the customer, you are supposed to know. You are supposed to know whether the customer is belonging to a high risk country or which country he belongs to. You are supposed to know. You are supposed to know his address. You're supposed to know where he is working, whether he's a, if he is a partner in a company, whether the company firm, whether the firm is into gems and jewelry, or whether the firm is operating a casino, or the firm is related to any cryptocurrency. You know? If it is a company, we should go to the MCA site and see whether it is not a striked-off company, whether it is any shell company. So these basic requirements, this is standard customer due diligence. Then we come to the enhanced due diligence. While doing standard customer due diligence, if we come across somebody who is of high risk, which is posing a high risk, for that person, that customer, that entity, we are supposed to do enhanced due diligence. Now, what is enhanced due diligence? You have to, if it is for a, suppose it, if suppose a bank has decided that a PEP will be a high risk, because as per indicative list, it is a high risk. If you decide that it is a high risk, then you will go, while onboarding the customer, you will insist for some additional documents, like his previous bank statement. Like you will go to the public domain and check if there is any adverse media report. You can go to the Election Commission website, and if suppose he has been a contestant, you can remove the affidavit and check the related persons, if there's any adverse media report, whether there is any during name screening you find anything negative about those persons who are related to the prospective customer. So this, you know, enhanced due diligence. Suppose you are doing an enhanced due diligence of a gems and jewelry business. You will visit the business place. You'll check whether there are stocks kept, whether there is, it is almost like when you give a loan. I know sometimes the customer says, why you want to see all this? Are you giving me any loan? You are just opening my current account. Why are you asking me all those? But yes, PMLA requires that we should do that. FATF requires that we should do that. So we have to visit the place, you know, we have to visit the place, we have to check if there are really stocks are there. We have to check if who are their customers. We have to check who are their suppliers. We are supposed to know what are the types of jewelries they are selling. You need to have a full feel of their business. And not only that, you know, if he's an old customer, he's an old jeweler, we are supposed to check their bank statement in their earlier bank, you know, because if he's newly onboarding your bank, he must be having some account in some other bank. So you have to insist for their statements to verify the transaction pattern in those. And only when you are satisfied with all these, suppose the customer is dealing with some customer or some supplier, and that supplier has been in an SDN list, that is a sanction list, we will not allow. Suppose he's doing trade and he's exporting it to a customer who is in a OFAC sanctioned country, we can refuse to onboard such customer. So an EDD should be positive to onboard a customer. You cannot say that it means if you are not satisfied with his transaction pattern in the earlier bank, if you feel that he is dealing with customers who are not reliable, who have been under some negative media news, who have been under some enforcement directorate scanner on SFIO scanner, and if you find that your prospective customer is dealing with any such person, you have full right to say no to the customer. You can refuse to onboard a customer. Let me tell you, regulator is very clear that if you are not satisfied, you can say no to a customer for onboarding. Now, is EDD done only at the time of onboarding? No, there are also other instances when EDD is done. For example, while onboarding a customer, he was a medium risk customer or he was a low risk customer. You have done standard customer due diligence and you have onboarded him. But after maybe 1 year, 1.5 years, whenever subsequently, during is there any issue, Shalini?
No, ma'am.
Oh, okay. I saw some pop-up, that's why. Okay, so during the review of risk categorization, if some customer turns from low, medium to high risk, you will have to do the EDD of that customer. So he is a existing customer, but because he has moved to high risk, you are supposed to do the enhanced due diligence. You're supposed to check the transaction pattern in the account. You're supposed to visit his shop or his business location and check if there is a board on his shop, whether there are employees in the shop, whether there is a proper business activity going on in that shop or in that factory or whatever. So this is how the EDD has to be done subsequently wherever the accounts turn from low, medium to high risk. So these are the two areas where EDD has to be done. Then let us come to simplified and due diligence. Now, what is simplified due diligence? It is exactly opposite of enhanced due diligence. Does it mean that for all low-risk customer, we should do simplified due diligence? No. For all low-risk customer, you have to do standard customer due diligence, the first one. But regulator has defined some categories for whom simplified due diligence is permissible. One of them is self-help groups, where they've said that you can do the CDD only of the office bearers. You need not do the CDD of all the members of self-help group. So that is where the simplified due diligence comes into picture. The second category where simplified due diligence comes into picture is for foreign students who have just arrived in India and want to open an account. Simplified due diligence is allowed, but there are some limitations. We do open the account of the foreign student with passport basis his foreign address and foreign identity proof, but then within 30 days he's supposed to submit the local address proof to the bank. Till that time, there are some limited transactions allowed, that is $1,000 credit is allowed, individual transaction, and not more than 50 lakh, something like that. Yeah, not more than 50 lakh, 50,000, sorry, not more than 50,000 credit is allowed. Okay, so sorry, I think it is $100. No, USD 1,000. Yeah. Credits only up to USD 1,000 allowed, but that too only up to 30 days. And if within 30 days the foreign student does not submit his local address proof, then the bank has the right to freeze the account. So this is all with regards to simplified due diligence. Then ongoing monitoring, as I told you all, CDD is ongoing. KYC is at the beginning. During re-KYC, risk categorization is half yearly, and transaction monitoring is almost daily. Daily, depending on the alerts generated in the AML software, or some alerts received from LEAs FIUIND, so from regulators. So continuous CDD transaction monitoring is required, it is mandatory to keep a watch on your customer. Then the last one is trade EDD. That is, this is required when customer wants to enter into trade transaction, that is overseas transaction. So whenever a customer approaches you to onboard, or your existing customer approaches you and tells you that I want to do cross-border transactions, I want to do some exports or imports or whatever. So in such cases, the banks generally do not allow the customer to start the transaction till they do the trade EDD. That is, again, similar to enhanced EDD, enhanced due diligence, but there are some more additions in it, because here they not only check the customers and the suppliers, but they also check whether which country he is going to export or import, which are the ports the ships are going to touch, which are the vessels they are going to use for import export, what are the commodities, whether those commodities are permissible commodities for transacting. So all this detailed trade EDD is done. There are some reports taken from the external agencies for the customers or suppliers of your customer. So suppose your customer X is going to deal with customer A in some Singapore country. So their reports are called for to check their reliability, and only after such trade EDD is done that the customer is allowed to do the trade transaction. Again, I'm telling you, these are the general banking practices. There can be deviation, there can be some variation in this. Various steps in CDD. Identity document verification, validation. As I told you all, if a PAN is taken, though it is not a OVD, again I'm telling you, it is taken as per the income tax regulations, but PAN has to be validated. You all are aware, and in recent guidelines, amendments in the rule, the PAN has to be valid also. If it is not valid, we are supposed to immediately freeze the account and call the customer to give the validated, get the PAN validated and submit as the valid PAN. So whenever a PAN is given by the customer, we are supposed to validate it. If it is not valid, you are not supposed to onboard the customer. Then, Aadhaar card, again, Aadhaar card is validated. Of course, we take the permission from the customer to validate it, and we get it validated. There are other tools, this to validate the driving license and this wherever possible, so validation, verification with original is one part, but again, it has to be, most of the documents are validated. If suppose they give a registration certificate a company gives, we check it on the MCA side, whether the company is active, whether the company is not a shell company. Then we check whether who are the directors on the MCA side, whether the DIN is valid or invalid. So these things are checked at the MCA side. So there are, wherever possible, things are checked. Sometimes it is not possible, especially the issue is with regard to proprietorship firms, where very difficult to really do any validation. But then we generally, the banks take more conservative approach while monitoring the proprietorship accounts as vis-a-vis the company accounts, because more of money laundering is observed in the proprietorship accounts, in the HUF accounts. So there are more stringent rules put in for those, not necessary that they are marked as high risk, but there are stringent rules to monitor those accounts. Next comes the address document verification through site verification or positive confirmation. Yes, again, the address documents have to be verified. So Aadhaar, it can be validated, but there are some address proofs where validation is not possible. As I told you all, maybe the driving license and election card or Narega card. In such cases, most of the banks go for site verification or positive confirmation. Site verification, the word is self-explanatory. That is, the bank employees go to the site and check whether that person is staying there. They check with in the society records, or they see the board outside the society whether the person is staying there. Sometimes they check with the neighbors. This site verification, if it is a business entity, they check whether the name board is there of the business and whether there are employees working there. All those things are there. Over and above that, if the site verification is not possible, suppose it is far, or if there is some organizations, they feel that the staff strength is not enough, the resources are less for site verification, then they can also go for positive confirmation. Regulator has allowed positive confirmation. What is positive confirmation? Positive confirmation is sending a welcome letter or sending the checkbook or the ATM card by post or courier, and suppose it does not return within 1 week, it is presumed that the address is correct, and then that is treated as a positive confirmation. Suppose it is returned by the post office, then in such cases, the account is immediately marked freeze, and then the customer is contacted that the address is not correct. So this is called positive confirmation. So address verification is generally done by site verification or positive confirmation. Then comes business verification through EDD or other means of verification. As I told you all, confirming the business. So by going to the MCA site, confirming the business by visiting the business place. So these are all the business verifications done. And last but not the least is name screening. Yes. Name screening is again very, very important, because every customer onboarded, name screening has to be done by every financial institution. This is not only the regulatory requirement, it is a PMLA requirement, it is an FATF requirement, it is an OFAC requirement, because we cannot onboard any terrorist, we cannot onboard any customer who is an part of an adverse media news. So we are supposed to track all such customers. So what generally the financial institutions do is they either subscribe to some lists available in the market, and plus they also have their own lists prepared, updated on daily basis. They have a software where every customer onboarded, the name, the PAN number, the Aadhaar number, date of birth, mobile number, address, these things, credentials are screened, searched in those lists, and if there is any match found, then the customer is not onboarded. Suppose a match is found with the UAPA list, then necessary reportings have to be done, which is covered in the master direction of RBI. But otherwise, if they are found to be, some absconding person, there is some fraudulent person, then the banks would not onboard such customers. If it is a terrorist or so, then necessary reportings are done to FIU and to the other regulators. So name screening is very, very important. It is not only done at the time of onboarding, but it is also done every night, because either if it is a new customer, it is screened with all the lists available on the bank's database. But there is a possibility that we keep on adding names in those lists. So that added name should also screen the existing customers to see if the existing customer is matching with any of this list. So there is a nightly screening also done for all these lists, for all the existing customers. So name screening is not only done at the time of onboarding, it is done on daily basis in the nightly screening. It is called scheduled screening. So again, CDD is an ongoing process. Transaction monitoring, transactions as per profile. As I told you, transaction monitoring, when the alert is generated, the alerts are scrutinized, and if suppose you find that the transactions are not as per the profile of the customer, you are supposed to report them to FIUND in suspicious transaction report. It is called STRs or SARs. Okay. So transaction not as per profile, that means suppose she's an housewife and you find huge transactions in her account, and that is something suspicious. Suppose there is a salaried person and you find that the transactions are not, there are no salary credits, but there are some transactions with non-individual organized entities, then you will say that it is not as per the profile. If it is a chemical industry account and the transactions are with gems and jewelry or constructions, you will say it is not as per the profile. So transaction as per profile. Further, the customer has declared some profile, declared some turnover in the account, some income in the account. So if that transaction is much above his income, declared income, again we'll say the transaction is not as per profile. Then transaction pattern displays, if the transaction pattern does not display any economic rationale, that is a customer is some amount is moving, a credit is received and immediately a debit is gone and leaving a minimum balance in the account, or amount is transferred from A to B and B to C and C to D and again D to A. There's no economic rationale identified, and hence such accounts should be treated as suspicious. Then transaction volume is not in line with what declared transaction, not consistent. That means the previous, like the transaction pattern in last 6 months was in the range of 50 to 70 lakhs, and suddenly he starts transacting in 40 crore, 100 crore. You are supposed to inquire with the customer that what is this, why this increase? Maybe the customer will say, I have got a big order. Try to cross-check his whether, who are the parties, whether he's doing this transaction with the related persons. No, then you can say that, okay, it is not suspicious. Otherwise, you have to report it saying that there is sudden surge in the transaction. Business transaction, suppose it is a current account and you find transactions only with individuals, and that too credits followed by debits, round amount credits followed by debits, it is suspicious. Ideal current account should have lots of transactions, and those should be business transactions with related entities. That is, if it is a textile company, the transaction should be with the person who is providing thread, or transactions should be the salary payments to his employees. That should be the transaction pattern in that. But if you find that the transactions are not as per the business profile of the customer in a current account, then it is suspicious. Saving account. Ideally, a saving account should have utility bills, investments. But if you find that there are transactions with non-individuals, there is a saving account where transactions are with Mahavir traders and Ambika traders, and a lot of cash withdrawals, a lot of cash deposits, then it is treated as suspicious. I purposely wrote everything in a positive way, that if transaction is as per profile, nothing to worry. If transaction pattern is showing us displaying economic rationale, nothing to worry. Transaction volume is consistent with the past pattern, nothing to worry. Business transaction seen in current account, everything is fine. Business transaction with related parties, and then transactions in saving account as per the ideal saving account, nothing to worry. This is how ongoing due diligence is expected by us, by the financial institutions for its customers. I think I'm done with my slides. I would request if there are some questions from the viewers.
Yes, ma'am. I have a few questions. I'll take the first ones. So the first question is, how is the CDD of accounts dealing in cryptocurrency expected to be done?
Oh, I always knew this cryptocurrency is going to come, because I know it is creating a lot of doubts in the mind of people that what is the future of cryptocurrency? What are the Yes, cryptocurrency is a topic. C for cryptocurrency, C for total confusion there. So let me tell you that RBI regulator was never in favor of cryptocurrency, and that is the reason right from 2008 they have been resisting that cryptocurrency should not be allowed. There was a circular issued somewhere in 2016 or so, I'm not sure. There won't be any, banks should not deal with cryptocurrency or should not allow opening accounts of cryptocurrency. But then then came the Supreme Court judgment where they said that the cryptocurrency should be permitted and should not be banned, or whatever. There are a lot of this in it. So later, recently, a few months back, RBI came out, basis the Supreme Court judgment, RBI came out saying that banks to take their own call, basis their own risk appetite. Means whether the banks want to deal with cryptocurrency or not is left to the bank's own decisions. So then it is for the banks to decide how to deal with it. Some banks are opening accounts, some are not opening accounts. If they are opening accounts, they are supposed to have enhanced due diligence for such accounts. They are supposed to check whether the transactions happening are in line with the profile of the Bitcoin. They should see the source and end use of the transactions. In fact, it is not only the accounts of the exchanges. There are some customers who have not declared that they are into cryptocurrency. They open account and then we find that there are transactions with cryptocurrencies. But then there we check whether it is just a form of investment, just a form of trade like the security trade, or it is something more than that. You have to see something beyond it, or you say between the lines, If it is, if we see that there are transactions, he is paying to the cryptocurrency, what is the source? Okay, it is his regular disinvestment of his FDs or his securities. He has sold the shares, he has got the money and he is investing in crypto. And if there are all other transactions in line with the profile, in line with his declared income, then we are okay. But suppose we find that the transactions are not as per profile. Suppose we find the source is not correct. Suppose he is depositing huge cash and then investing in cryptocurrency. Or suppose he is getting money from cryptocurrency and then he is doing some layering business. Then in such cases, we will be reporting it as suspicious transaction. But otherwise, there is a lot of confusion. We cannot, there is no thumb rule to say that cryptocurrency is legal or illegal, or whether we should report all cryptocurrency accounts straight away in this, because that is also not correct, because still there is no decision from anybody, from government, whether it is illegal. So till that time, we go by our regular scenarios, saying that if the transaction is as per the profile, we will not report it. If transaction is consistent with the past pattern, will not report it. If we find that the transactions are within the declared income of the customer, we will not report it. That is, I think I've given a clear picture of what.
Yes, ma'am. I think the other questions related to cryptocurrency have also been answered by you. So I'll not take the cryptocurrency questions again. So I'll move to the next question, which is regarding the IBC. So this question says that practically the banks are not doing CDD in many cases, noticed in the IBC cases. What action IP should take on such lapses by the bank?
Sorry, I didn't get what? IBC?
Yes, ma'am. It's a question. It is not actually related to anti-money laundering directly. So I think we should skip this question. Then, ma'am, the next question we have here is that regarding account opened online through bank apps, are they KYC CDD compliant?
So this is the accounts are opened. You all are aware that there is a lot of competition with new products coming in, and there is one of the product is the banks allowed to open the OTP based eKYC account, non face-to-face accounts. And yes, RBI permits it. It is as per the RBI guidelines. These accounts can be opened basis just PAN and Aadhaar uploading. And but only thing is, these accounts have some limits. They have some limits. That is, they cannot have balance more than 1 lakh. Then their credits cannot be more than 2 lakh in a year. And even you can open a loan account through OTP based eKYC, where the limit cannot exceed 60,000. But then these accounts, you cannot say they are non-KYC. They are KYC. Of course, they are KYC compliant because we are taking Aadhaar. The Aadhaar is validated before the customer is onboarded. It is automatically validated. PAN is validated before the account is opened. So these are KYC compliant account. Now what is left is CDD. CDD, what we do is, though because it is non-face-to-face customer, we cannot ask him various questions. But the softwares are so made that there are because while opening the account, he mentions that he's a student, she's a housewife, she's a this. So, and there is an age mentioned. There are some artificial intelligence is used to check that by and large whatever data is given by the customer is correct. Moreover, banks have different set of rules to monitor these accounts. They are more speedy, like there are daily rules. In fact, there are some even the credit comes, and there are softwares where immediately a flag is given that, oh, the credit has come, and immediately the debit is going and it is stopped immediately. There are that type of softwares used to keep a watch on these accounts, because yes, all said and done, yes, there are a lot of these OTP frauds and this, where these accounts are used for laundering the money, for frauds, not laundering, I should say, for frauds. These are used, but there are stringent rules to monitor these accounts, stringent rules. And plus the amount limit is there as per the regulator. Have I answered, Shalini? Is there anything else? I can't hear you. You are on mute. You are on mute.
Yeah. So, ma'am, that was the last question that I had taken. So I would like to thank you, ma'am, for your detailed deliberations on CDD. And I would also like to thank Muralidharan sir once again, both of you, for sparing your valuable time, for sharing your extensive knowledge on KYC and CDD. I would also like to thank the participants, the members and the stakeholders for participating in this webinar. So thank you, everyone. Thank you so much.
Shalini, thank you so much for inviting me for this. Thank you so much.
Thank you, ma'am.